Welcome to Stocks in Translation, Yahoo Finance's video podcast that cuts through the market mayhem and the noisy numbers to give you the information you need to make the right trade for your portfolio. I'm your host, Allie Canal, in for Jared Blickery. And with me today is the wonderful Sydnee Freed, aka the voice of the people. Kindly like, subscribe, and comment on Stocks in Translation on Spotify, Apple Music, Amazon, or YouTube. Kicking things off with our phrase of the day, which is bear market. We're officially halfway through 2025, and even though stocks have been trading at record highs, Wall Street is still feeling cautious as we head into the back half of the year. Our number of the day is 4. The July 4th holiday is on Friday, so we're going to take a look at consumer spending and what all of this says about the overall health of the economy. Here to help break things down is Mangrove Chief Market Strategist Kristina Hooper. Welcome to the show, Kristina. And what a time to have you, because we're 6 months into 2025. A lot of uncertainty still in this market. So what is your bird's eye view of where we're at today?
So I think we're seeing a U.S. economy that is deteriorating. I think of it as different sickly canaries that are appearing in the coal mine. They're not dead yet necessarily, but they're showing signs of real illness. And we're likely to see more, I think, as the year progresses. And so I would call out a few different things we're seeing. First of all, consumer confidence has taken a hit. In fact, just last week we got Conference Board consumer confidence, which was surprising in that it was lower than expected and amongst different political groups as well. What we're seeing also is just signs of reduced consumption. We're seeing a pickup in continuing jobless claims. We're at the highest level since November of 2021. So all this says to me is it's not many canaries yet, but I think what it's telling me is that this economy is deteriorating.
And we will be digging into the economy after the break here a little more intensely. But just in terms of the markets, we're at record highs. What are they missing? What are they getting wrong? And do you think leadership is a little too narrow at this point?
Great question. So I think where we are right now, valuations are sky high. If we look at it relative to history, if we look at cyclically adjusted PE ratios, typically when we get to this high a level, usually there is a sell-off. So I think that is concerning. I'm worried about that. I'm also worried that leadership is quite narrow. It has broadened out a bit, but it is still quite narrow. And what is hard for me to get my arms around is that as we all know, we had that sell-off in April around the U.S. tariff announcements. We've had this incredible recovery, made everything back, exceeded the highs in February, but I'm not sure what the catalysts are. During this time, what we've seen is actually revisions downward to earnings growth expectations for the fourth quarter. We've gone from about 9.4% to about 5%. So I don't necessarily understand where the excitement is. Economic policy uncertainty is sky high. We still don't know if the tariff situation is going to be resolved. We're really only on pause until July 9th. So all of this today tells me that stocks are climbing a wall of worry, but at such high valuations, there is incredible vulnerability.
Is it AI, like excitement still, that's causing stocks to turn around? Or you said you don't know what it is.
Or I've been hearing that maybe we're past peak uncertainty and the taco trade, Trump always chickens out, that maybe on the trade and tariff front, it's not as bad as we previously thought.
Well, I think there's some truth to that, but I still don't see that as credible catalyst to drive stocks to record highs.
So what do you do then? You're saying there's some concerning risks in the market. What is an average investor to do to kind of hedge those risks right now?
So I think investors should look at their allocations. This is a wonderful time. We're mid-year. So this is a wonderful time to assess one's portfolio allocations and rebalance. That's just a healthy exercise to do no matter what the market environment is. And mid-year is a great point to do it. Chances are a lot of investors will be overweight the U.S. And chances are they'll be overweight certain parts of the U.S. stock market, just given what has led this rally. At the same time, they may be underweight Europe, the UK. They may be underweight other parts of the world in terms of having exposure to gold, having exposure to areas that are good diversifiers, alternatives, for example. So I think this is a good time to rebalance one's portfolio.
And how do you view the retail trader of it all? We saw retail traders aggressively buy the dip back in April. What does their behavior tell you about the current sentiment that's waiting around the market right now?
So I think there's clearly a lot of positive sentiment. But having said that, that can be problematic, right? Because there tends to be a herd mentality in markets that can develop. And I think sentiment is so positive that perhaps some investors aren't necessarily as discerning as they should be.
You mentioned Europe and the UK, potential bright spots. What makes those regions appealing right now?
So what I like is that valuations are very low. Dividend yields are higher than the U.S., as well as having lower valuations, significantly lower than the U.S. And also the buyback yield is quite high in the U.K. It's solid in Europe as well. So to me, there's a real contrast there, and it's a wonderful opportunity to diversify. I also think there's a catalyst that's quite significant in Europe and the U.K., and that is the potential for, well, it's really a reality, increased defense spending, right? We just saw this big NATO agreement last week. So these countries are going to be ramping up defense spending. They've agreed to get to 5% of GDP by 2035. That's far from where they are today. It's going to ratchet up. It's going to represent fiscal stimulus. At the same time, the U.S. is withdrawing fiscal stimulus. And the fiscal stimulus that we do have built into the budget that presumably, or some form of it will get passed soon for next year, it emphasizes areas of government spending like tax cuts for wealthy households that tend to have lower multiplier effects than other line items of government spending, like transfer payments to states. So think about social benefits, for example, food stamps as one example of that. More of that gets spent, more of it goes into the economy. Even tax cuts for lower income households, more of that gets into the economy, so it has a higher multiplier effect.
How much international exposure is the right amount for, say, a passive investor versus someone who's a little more active?
Well, it really depends on the investor, their age. There are so many different facets of this. And so I would expect that a U.S. investor would have more exposure to the U.S. than any other part of the world. But having said that, I think it makes sense to have perhaps 20% exposure outside the U.S., maybe 25% exposure. But that's thinking in terms of both stocks and fixed income.
Okay.
Right? I think we have to think broadly. And also, of course, there needs to be, in my opinion, that exposure to alternatives. That's where you can get really strong, powerful diversifying effects. Or historically, we've seen that a lot coming from the alternative space.
But in fixed income, isn't the U.S. sort of the only game in town at this point, which is why when we were seeing a lot of volatility with bond yields, there wasn't that much of a concern when it comes to, yields running wild, because at the end of the day, there really is no alternative.
Well, I think that's true to a certain extent, right? There is the potential to diversify. For example, exposure to U.S. Treasuries. To a certain extent, it can be diversified through exposure to German bunds as well. And I think there is that concern we should have about the potential for an increase in bond vigilantism, especially given the potential for increasing overall debt to GDP levels quite significantly. So there's that. I think in the credit space, yes, I think U.S. credit is very attractive right now, but I also think European credit is attractive as well. So I think there are ways to diversify on the margins.
I'm just freaking out about, what did you say, 20, 25%? I guess I got some work to do.
Well, again, this is very much a not one size fits all but I think investors should ask themselves, am I adequately exposed? Am I overexposed to an area with very high valuations? Sometimes we can create diversification just by reallocating within the U.S., but I do think it's important to have exposure outside the U.S.
And you're not the only strategist who's been saying this. I feel like there has been this big conversation point about looking overseas. And that's not to say that the U.S. isn't exceptional anymore, because that also has been a big topic, whether or not the U.S. exceptionalism trade maybe has lost a bit of its luster. What do you say to people that are a little concerned about where the U.S. is relative to the rest of the world?
Well, I think it's all about strategic allocations. the most powerful thing that investors can do for themselves is to make decisions in a vacuum, right? So create an investment policy statement, sit down and say, what would be the ideal allocation? What would be the band that I could tolerate? And then allocate based on that. Having said that, I think many are overexposed to the U.S. stock market, and this is an opportunity to rebalance and gain more exposure outside the U.S. I do think there is more vulnerability. It's not just about valuations. It's not just about sort of short-term growth prospect. We also have to worry about the Treasury market. I think that we could see a scenario where bond vigilantes become more aggressive, and we see yields go up on the long end, and that could put downward pressure on stocks. So I'm loath to talk about U.S. exceptionalism having gone away, but I do think that certain facets of what has made the U.S. stock market so strong and the U.S. economy so strong in recent years might be waning. At least temporarily.
Right.
And so to me, it's not about the short term. It's like, let's think about our strategic allocation because chances are we're underweight.
Now is a good time to kind of rebalance? Is it because we're midway through the year, because it's summer, because we're at all-time highs? Like, what makes it a good time to rebalance?
I think because we're midway through the year, we've seen pretty significant movement this year. I mean, if we woke up, we'd say, oh, it was a pretty boring stock market. But if we actually were awake for every day of it, we'd say it was a pretty eventful 6 months.
Oh, yes.
But I think part of that discipline and structure of having an investment policy statement is to say, I'm going to rebalance mid-year and end of year. So to me, mid-year is just an opportune time to do it.
And I've been hearing a lot about focusing on high quality names. How do you define high quality within this market?
That's a great question. I think one person's quality may not be another person's quality, but in my opinion, it's strong cash flow. It is not a high level of debt. It is companies that some would refer to as growth engines or to a certain extent cash cows. Those tend to be areas that perform well in environments where we need some defense. So
that's NVIDIA, Netflix.
Interestingly, I'm so old. I got into this market and into this profession in 1995. So I lived through tech not being considered quality at all. But the times have changed, and a lot of the high quality names are cash cows with low debt in the tech space.
The AI revolution, like Sid alluded to. But we're going to take a short break. We'll be right back with Kristina and more Stocks in Translation. Welcome back to Stocks in Translation. We're here with Man Group Chief Market Strategist Kristina Hooper. So Kristina, we just talked a lot about the market, and I want to narrow in on the economy. You alluded to the fact that we might be underpricing a lot of these economic risks. So when you think about where we're at today, what's the disconnect between why we're seeing stocks doing so well while we're seeing this euphoria? In the background, there are so many concerns.
I think it's because it's very hard to quantify the risks. Think about tariffs, which loom very large, but it is hard to model out exactly how this plays out. What will ultimately be the tariffs set on goods from different countries, especially China? How will this all play out? So I think it's easier to ignore it than to try to model out so many different scenarios. And then I think there are other factors that just aren't getting enough attention, that are happening without a lot of media exposure. And I would say government cuts is one of those, where I think we're going to have a significant negative impact to the economy because, again, we're losing some of those line items of government spending with high multiplier effects. To the extent they are being replaced somewhat, it's lower multiplier effects. I don't think that's being factored in either.
When do we go from like you're a little concerned about the economy to you're a lot concerned? You mentioned like a pickup in jobless claims. We saw the highest level since November 2021. What data do you look at, and how many bad data sets do you have to become very concerned?
So I would say that I'm quite concerned at this point because there are other issues like, for example, immigration, which can be very, having an aggressive immigration policy can achieve some goals, but at the same time can be very negative for the economy. So all in, I think this is a policy mix that essentially can be a significant policy error and send the economy into recession. So for me, it's about watching the signs. I hope I'm wrong. I hope I've gotten this terribly wrong. But certainly when you see those canaries appearing, the rise in continuing jobless claims, it's cause for concern when you see that drop in consumption. You just want to follow it closely. When you see an uptick, as we're seeing right now, in delinquencies for mortgages and home equity lines of credit, we want to pay attention. It could just be an anomaly, a short-term issue, but I worry, especially at the same time you have a very significant change in student loan policy. So we've seen a big ratcheting up of student loan defaults. For those that are paying, that's going to add significant pressure to their budgets. So we just want to follow this very, very closely. And we know, of course, that there are large banks that are already planning greater delinquencies. They're adding to their loan loss reserves, and that is another sign. They're certainly seeing things or anticipating things as I am.
And a lot of pros we've been speaking with have told us that immigration, DOGE cuts, a lot of those risks, we're not going to see that show up in the economy until later this summer, maybe even the fall. So that's a great point there. And I also want to talk about the state of the consumer because there are two main surveys that we look at when assessing that. There's the University of Michigan Consumer Sentiment Index and then the Conference Board Consumer Confidence Index. And I thought it was interesting because in June, we saw a bit of a dispersion between the two. Sentiment ticked up, confidence pulled back. How is that possible?
It can be a matter of timing in terms of when the survey has ended, and there are certainly differences in the dates that a survey is conducted. It's also different groups being surveyed. Now, interestingly, the view has been that typically we see better, more positive views coming from Conference Board, not Michigan. Although they're somewhat aligned with differences in political affiliations. That was not the case this time. It was almost like a crisscross.
Yeah.
And we got something a little counterintuitive. So I think, some of it has to do with headlines and when a survey ended and could they have gotten more positive news. But it'll be interesting to see. Usually there can be a disconnect. I think for a long time what we've seen is just this drop in sentiment coming, most notably from Michigan, and everyone's waiting for it to show up in the data, in the hard data, right? It's a soft data story, and there's typically a lag, but this has been a longer lag. But it's not that different than the lag between when tariffs were announced and plans were made. And, that lag waiting for it to show up in the data. And that may have, I would argue, show up at least somewhat in core PCE last week. So it takes time to make it in, and we'll see how it goes from here.
We've talked to a few people who aren't soft data lovers. What would you say between evaluating the economy using soft and hard data?
You have to take it with a grain of salt. It doesn't always result in hard data. It doesn't make its way into hard data always. But again, because I'm already hypersensitive, I'm looking for canaries in the coal mine. Again, I don't want to find them, but I'm looking for them. So I'm paying a lot of attention to the soft data.
All right, now it's time for a segment we like to call Lost in Translation, where we get our guests' take on what the market might be misunderstanding. So sticking with the recession theme here, you are focused on a U.S. recession caused by policy mistakes. So what do you define as policy mistakes? Are you talking more about D.C. or is it the Fed?
So it can be all of the above. especially combined. I think the Fed is in a very difficult spot right now because it has to wait and see for that soft data to translate into the hard data to see exactly where this economy is heading. Because it could very well be that looking in the rearview mirror, they didn't need to do anything. And so they're going to err on the side of sitting on their hands and waiting. That could be a policy error. And it could add to, for example, pressure on rates that hurts the consumer. But of course, we know that it's not just rates on the short end, it's rates on the long end. And as the Treasury Secretary said several months ago, we're going to focus on the long end because we think that matters more. And, the Fed to a certain extent can impact that, but not entirely, certainly. So I'm thinking policy error from wherever it may come from.
I feel like we debate a lot, or not we, but the people we talk to, when the Fed is going to cut. Is it that big of a deal if they cut in 1 month, in 2 months, in 3 months? You know what I mean? And is it a big policy error if they miss it by one meeting, right?
They don't think so.
But you do.
Well, it's interesting. I like to give them the benefit of the doubt. They're seeing a lot of data. They're being thoughtful. They're trying to make decisions. But of course, we know that they can make mistakes. We know that they were late to act when inflation was rising. So I certainly think it can have an impact on the margins. But so can the talk coming from the Fed. And it's interesting because we're getting a lot of differences between what Chair Powell's saying and what we're hearing from some of the members, two of whom have said in the last week or so that they would support a rate cut in July.
And speaking of a rate cut in July, I feel like we would only get that if we saw a big deterioration in the labor market. So to me, my mind goes, all right, well, now we're cutting for bad news. If we get a Fed cut, is that ultimately maybe a detriment to this market rally?
If we get a Fed cut, I don't think it's going to impact the rally in the shorter term unless it comes with some ominous warnings. I think what stock market investors would love to see is the best of both worlds. A cut, but the Fed saying it's preemptive and it just wants to make sure the economy doesn't deteriorate, but things look pretty good. And they'll take it and it'll help fuel more of a rally.
Just 30 seconds to go. How should Americans think about preparing for a possible recession or downturn? What's your advice?
Well, just to remember that typically the stock market acts in advance of a recession, and that your typical recession, you get a stock market sell-off of between 20 and 25% in advance. So think about that in terms of your strategic allocations and what you look at for rebalancing mid-year.
All right, Kristina, some great advice. Thank you so much. Appreciate you joining us. And we're winding things down here at Stocks in Translation. But make sure you check out other episodes of our show on the Yahoo Finance site and mobile app. We're also on all of your favorite podcast platforms, so be sure to like, leave a comment, and subscribe wherever you get your podcasts.